third quarter earnings that largely beat expectations. Net bookings surged 105% from a year ago, and the company said 2026 sales are unlikely to fall below 2025 levels. However, the CEO warned that business in China will be, quote, significantly lower. Still, shares rose more than 3% after the report. As a reminder, ASML is not a chip company. ASML makes the machines that make the chips that are then used to make these AI models, but they are still very much at the center of the AI infrastructure trade, especially because as of now, there are essentially no companies that have the tech capabilities to do what ASML does. All right, for more on what these earnings mean for ASML and for AI, we have Andrew Gardiner, Head of European Technology Equity Research at Citi. Andrew, thank you for joining us on Prof Markets.
Thank you for having me.
Let's just walk through the ASML earnings here. What were your main takeaways? What did we see this quarter?
Yeah, I'd say there's two fairly key high-level takeaways from the results. One around the bookings themselves that they took in the quarter, and then secondly, sort of what that is meaning, what the bookings and indeed the interactions they're having with the customers is meaning for the outlook into 2026. So, firstly, on the bookings, 5.4 billion euros of bookings in the quarter. That's a healthy number. Not dramatic, but fairly healthy. And what you're seeing within that mix is that both memory customers, the likes of Samsung, SK Hynix in Korea, Micron in the US, as well as the logic customers, TSMC, Samsung as well, are ordering. So there's a good breadth to the order intake from ASML, particularly so on the memory side, which I think is both a cyclical statement as well as a structural one. And then in terms of what that means looking into 2026, this is a company that's got very long lead times, 12 months for some of the most advanced tools. And so their visibility is steadily improving into next year. And after a rather sort of tough few quarters, particularly with second quarter where they had to walk away from the expectation of growing in 2026 because of the uncertainty out there in the broader market. They've now said some of that uncertainty has been answered during the last 3 months. And so now they're willing to say it will at least be flat, if not grow in 2026. That's something that certainly the market took positively this morning here in Europe and why you've seen the shares trade well.
Tell us a little bit about what that uncertainty was and the sense in which it has been answered over the past few months.
Yeah, so there was both, I think, macro top-down uncertainty, tariffs. You're still very much on the radar for the entire chip industry. And back in July, particularly for ASML, who were they're always the first to report, that uncertainty was still quite apparent in terms of the broader environment. But also, there were customer-specific issues, and that really began around this time last year with both Intel and Samsung on the foundry side, where both have had fairly well-reported challenges in terms of ramping new technology, getting new customers on board. And while not all of that has been answered in the last quarter. Some of it has. And you've seen Samsung announce new deals, particularly for the fab in Texas with Tesla, with Apple. You've seen investment coming into Intel from a number of places. And so some of that uncertainty is ebbing away a little bit. Not everything's been solved, but definitely a little bit better than where we were 3 months ago.
Yeah, it certainly seems that ASML strikes a very cautious tone. More so than I would say a lot of other companies. Perhaps that's the European in them versus the American. But, as you mentioned, the last time when we looked at the earnings, there was this concern over macro uncertainty, concern about tariffs. And one of the things that we were sort of struck by is, the extent to which that dragged on ASML, but didn't seem to drag on a lot of other AI stocks. I'm wondering if you noticed that as well, if that caught your attention.
Yeah, there's been a definite disconnect, I think. And there's a few reasons for it. I would say, you talk about ASML's perhaps cautious tone. That isn't always the case, but certainly over the last year, because of the challenges, both top down and bottoms up, so I was just talking about, they've been in the unfortunate position of having to cut some of their longer term targets. And really, it's the first time in the last 15 years since they started setting medium and long term targets coming out of the global financial crisis that they've had to do that. And so I think that has naturally caused them to be a bit more cautious in recent quarters.
Yeah.
The other thing in terms of the disconnect between some of the excitement that you see elsewhere within the AI supply chain and what you see in equipment, I think is quite telling. It was something that we as a global team within Citi have been talking about the last couple of months. It did feel like coming through the second quarter that you had all of the hyperscalers beating and raising in terms of capital spending. Wasn't yet filtering into the chip names, but then clearly over the last month or so, you've seen myriad deals announced, NVIDIA, AMD, etc. And so that it sort of come down one layer, and yet still, when you're getting down into the actual supply chain where these chips are going to be built, you're not yet seeing the orders. So Jensen Huang, Sam Altman walking around talking about hundreds of billions of dollars worth of chips. And yet there's ASML today reporting 5 billion euros worth of orders. As I said at the start, it's healthy, but it's not record levels by any means. So and they got a lot of questions on this, the management team, during the conference call this afternoon. And visibility is improving. They're clearly having those conversations through the supply chain with their customers and the customers, but it's not yet materializing orders. Something that I do think has to come in the next few quarters. Otherwise, the fantastic numbers in terms of chips that are being talked about, the number of data centers, the lead times in this industry mean that it's going to be harder and harder to achieve those on time if we don't start to see the orders flow through.
The other concern that was mentioned on the call was China. The CEO mentioned that there was perhaps going to be a dip in Chinese demand and therefore Chinese revenue. Could you speak to what we learned about ASML and the relationship with China?
Sure. China has been a strong revenue driver for them for the last few years. It's true for the entire semiconductor equipment space as China has been building out their capacity. And there has also been a regular refrain from the equipment industry, ASML included, at least over the last year, that the Chinese revenue would start to decline, in some cases quite meaningfully. And when we started 2025, ASML was saying they expected between 20 and 25% of revenue to come from China this year. As we came through the first couple of quarters, they were doing a bit better than that, 27% through the first half. And so they were saying, look, it's probably a bit above 25. And then in the quarter they just reported this morning, as 42% of their hardware sales in the quarter. So it really stepped up materially. And so, I think it's probably going to be north of 30% by the time fourth quarter is said and done. So still a very strong year from China. And therefore, they're again saying, look, we don't think that it is a sustainable level, probably comes back into the low to mid 20% range over the long term. So they're sticking to that message, even while in the near term, they're continuing to ship more than they had anticipated. So the demand is there. It's certainly not slowing down.
I'm so struck by the tone of ASML. I compare it to the very hyped up AI stocks and Tesla. I mean, I'm just looking at the net bookings doubling and seeing all of this growth in China. And yet the tone is, again, we're worried about this. It could come down. Don't get too excited, which is very interesting, especially when you look at the stock, which is up, 30% over the past couple of months.
Yeah, indeed. It's had a dramatic turn. I'd say in talking to investors in the July and August timeframe after second quarter results, people would engage, but you were struggling to get commitment. There was a sense that either numbers needed to come lower for those who were most bearish at the time for 2026, or even if they believed the numbers, they wanted their hand held a little bit and they wanted to speak to management, wanted to understand what was going on. There was just a lack of conviction. And all of that changed very rapidly. I mean, even by semiconductor standards during the month of September. And I think it was just sort of the news flow was just building day after day after day in terms of these deals that were being talked about in the AI space, and also the memory market. Pricing in DRAM really had started to turn positively, and the combination of those things, finally gave the market that conviction. It's like, okay, the industry data points are telling me 2026 shouldn't get any worse than is modeled, and so I'm gonna, as a market, I'm going to feel more comfortable in buying this stock and indeed this group. And that's essentially what ASML have confirmed this morning, right?
Yeah.
2026 has been reset to an achievable level, and we can now look forward to growth in 2027 and beyond.
All right. Andrew Gardner, Head of European Technology Equity Research at Citi. We really appreciate your time. Thank you.
Thank you, Ed.
So, strong quarter for ASML. And if you are a regular listener to the show, then perhaps you saw this coming. Perhaps you even own the stock, because yes, we did predict this. Back in July, when we last discussed ASML, we said the stock was on sale. We said that ASML was a buy. Our conclusion here is that we might have some dislocation on our hands. And as a result, we think this is probably a buying opportunity. Our thesis is that ASML just got put up for sale. As of market close on Wednesday, July 16th, yesterday, it is 8% off on ASML. And for no other reason other than the CEO is buying into the tariff drama while the rest of America isn't. And that to us spells buying opportunity. That was July 17th. The stock was trading at around $740 per share at the time. Today, it is trading at over $1,000 per share. So our prediction was correct. Indeed, we did see Taco. The tariffs did not impact the earnings, and the stock in the past 3 months has risen 35%, one of the best performing stocks in Q3. And it is also now the most valuable public company in Europe, $390 billion market cap. It is now ahead of LVMH, which is at $350 billion, and also ahead of Novo Nordisk at $250 billion. So good call there. At this point, we think the company is pretty much fairly valued. In other words, we don't see the kind of upside that we saw 3 months ago. But at the same time, this is still a very strong company, strong moats, very well positioned in AI, and it has not been subject to the same hype that we have seen with many of these other. Hinted about bringing podcasters onto the platform a few months ago. We actually discussed what that might look like back in April.
Netflix will overnight be able to they'll own a bunch of podcasts. They might start early by just being a distribution platform, learning about it, making some ad revenue. And then they will go vertical and either launch their own or buy some. And they will make, I would bet within 24 to 36 months, 3 of the 10 biggest podcasts in the world are owned by Netflix.
And now it appears that they are indeed going ahead with it. We will see podcasts on Netflix. Let's give Scott Galloway a call. Let's see what he makes of this move. Scott, good to see you.
Good to be seen, Ed. What's going on?
Not much. I see you are outside the pub. Are we interrupting something?
So, Ed, I'm here at a classic British pub, which means I have American tourists in town. It's like when you live in New York, the only time you go to Broadway is when tourists or your mom's in town and they force you to go to Broadway. I would much rather be at a douchey LA-like members club, but I've been dragged to one of these British pubs with my LA friends. Anyways, here we are.
Here we are. We want to get your reaction to this new move from Netflix. They are getting into podcasting officially. We talked about this a few months ago, how that might be happening. Now we know for sure Netflix is getting into podcasting. Your reactions, what that might mean for the podcasting industry?
Well, we predicted this. What this is it's squarely an indication that Netflix recognizes that their biggest competitor isn't Hulu or Disney Plus. Their biggest competitor is YouTube. And YouTube is now the largest distribution platform for podcasts. 25% of the people who listen to this podcast will watch it on a TV, streaming it off of YouTube. So they recognize that they need to be in that game. This is, and in addition, podcasts are the fastest growing ad-supported medium in the world. Alphabet grew, I think, 13%. I think Meta was 16%. Podcast ad revenue was up 18%. Now, granted, that's up off a much smaller base, but there really isn't a medium that's growing faster than podcasts. So this just makes all the sense in the world. I think we predicted this about 6 months ago. I'm shocked it took it took this long.
One thing is kind of interesting, these are exclusive deals. So basically when the podcast gets added to Netflix, and Spotify, by the way, it's a partnership, the episode is taken off of YouTube. So you have to kind of choose. Any reactions to the way they're structuring that?
Well, again, above, see above, they see YouTube as their competitor. So
Yeah.
Netflix is flexing their muscles and says, well, that's about 40 empty bottles of Guinness right there. So look, Netflix is flexing their muscles. They're like, we could be and should be the largest distribution platform for podcasts, or could be. We can put you in front of 150 million eyeballs on the home screen. The home screen for Netflix is, maybe with the exception of the home screen on Instagram or the Google query box, is the most valuable real estate in the world. And so they've said, look, if you want to have a shot of being a featured podcast, you can't be on YouTube. So, I get it. What they've also done, though, is the content, they're very strategic. They're doing sports, they're doing crime, they want to stay out of politics. I'm shocked they didn't go into business. I called Ted Sarandos about 6 months ago and said, why aren't you in podcasting? And he's an incredibly smart, kind of reeks of class kind of guy. And he said, well, we're thinking about it, we're looking at it. But Netflix could be a kingmaker here. Those podcasts are going to be overnight some of the biggest pods in the world. And in addition, what they're doing here is what Netflix does. What their strategy is I call it the Allied World War II strategy. And that is, the Allies the Germans had better tanks, better officers, better guns, better planes. But what they didn't have was gasoline. We had 38 gallons of gasoline for every 1 gallon the Allies had. And the Allies basically just overwhelmed the Axis power with gasoline. And Amazon and Netflix basically overwhelmed the competition with capital. And in addition to just more gross tonnage of capital, Netflix produces more for less than anyone in the world in terms of quality of content. And the way they've done that is through these arbitrages. The first was an arbitrage through geography, right? They're essentially producing stuff, over 50% of their content budget is spent overseas because they can make a film for 70% of what it costs in America and Spain, and maybe less than that in a place like Seoul. And in addition, this is the next arbitrage, and that is a medium arbitrage. So if you look at Prof G, and we've been open about this, our kind of top line is about 15 million, conservatively 20 people, that's 750 grand per employee. Let's look at TV, Jimmy Kimmel or Stephen Colbert, 60 million, 200 employees, 300,000 per employee. Comcast, CNBC, all those guys, $200,000 to $300,000 per employee. So effectively what's happening is they're arbitraging the medium. And what's happening is that essentially podcasts are becoming TV, and TV less slowly is becoming podcasts. And that is, podcasts are essentially TV with a strong audio overlay that are 70 or 80% of the production quality, if they do a good job, of television at 10 to 20% of the price. So Netflix is going to be featuring TV shows that were traditionally known as podcasts that cost 10 or 20% as a similar TV show, but already have a built-in audience. I think this raises the stakes. It's going to increase the production value of podcasts, but essentially podcasts are the new television.
Will Prof G Markets be on Netflix in the next few years?
No, but what we'll likely do, in all seriousness, is we'll likely find distribution. We will find distribution on television. We will take elements of our podcasts, we will cut them up, edit them for television, and then use MSNBC or CNBC or CNN or Netflix as a point of distribution and be able to strike a deal, because the incremental cost to the network of having good quality content will be pretty minimal, and the incremental cost to us for new distribution will be pretty minimal. So, effectively, podcasts are smaller businesses that are much more profitable than traditional television. And that's going to be very attractive. If you've got 2 hours of open space on the weekend for an MSNBC or CNBC, Why wouldn't you take the best business or the best politics podcast, edit it for TV, increase the production value, and just split the revenue with the podcast producers, and it's no incremental risk to either party. So you're going to see TV become more like podcast and podcasts become more like TV. The mediums are converging, but ultimately the two big takeaways here are Netflix and YouTube have opened another front in the war against each other. And this is just arbitraging the means of production to produce content at a lower price, which is what the industry is looking for.
All right, Scott, enjoy your pub dinner. What did you order? Accelerate AI infrastructure spending. So BlackRock, NVIDIA, Microsoft, xAI, they're all teaming up and they're going to buy this company, Aligned Data Centers. For context, this company was last valued in January at $12 billion. 9 months later, we are now at $40 billion. So this is a very rich valuation. It is also a rich valuation when you look at this as a multiple of sales. The company is doing about $1.5 billion in revenue, which would value the company at 25 times sales. That is far higher than Aligned Data Centers competitors like Equinix or DLR. They trade at around 10 times sales. So what are BlackRock and NVIDIA and all these investors, what are they so excited about? Well, it's pretty simple. Data centers are the hot new thing. Everyone wants to build one. Everyone wants to design one. Everyone wants to invest in one. This deal is one of many deals. We have seen roughly 1,500 new data centers announced this year. And in most cases, as with this one, the investors are paying a significant premium to get in on the action. So this is really nothing new. And it got us thinking, especially after our investigations into OpenAI and their spending ambitions. It got us thinking, how realistic is any of this? All of these data centers that we are seeing, is it hype or is it legit? Are we really going to see thousands of data centers? Or are investors getting overexcited about this to the point where it doesn't really make sense? Well, our research lead, Mia Silverio, uncovered some data that we found quite intriguing. And what it tells us is that despite all of the investment that we're seeing that is pouring into these data centers, the data centers themselves are not actually getting built right now. In fact, of all of the data centers that have been announced, only a quarter of them are actually undergoing construction. And this is especially apparent when you look at the earnings of the companies that actually do the building for these data centers. Jacobs Solution, for example, this is the number one company for data center engineering. Their revenue is actually flat. It hasn't grown in 2 years. Fluorcorp, which is one of the top data center construction companies, they actually just reported a 6% decline in their sales and also a 12% decline in their backlog, i.e. the sales they're going to see in the future. So when we look at the data center activity that is happening, yes, a lot of investment, but not a lot of actual building. And then there is this other unanswered question, which is how all of these data centers are going to be powered. How are we going to supply the energy for all of these data centers? The number of interconnection requests, that is the applications that are required to connect these centers to the electric grid, i.e. power them, the number of those requests is currently 10 times higher than the number of data centers that are being built. In other words, the grid is overwhelmed right now, which means that it's not even clear if there's enough power to keep the data centers' lights on, which is why, by the way, these construction timelines to build these data centers, they keep on getting extended out by 4, 5, in some cases even 6 years. It's also why electric costs have doubled in the areas where data centers have been built. There is this mismatch between the supply for the data centers and the demand for the data centers. We keep on seeing all these deals about how all these data centers are going to get built. And then when it comes to actually building the thing, suddenly a lot of doubts come up, a lot of questions arise. And in many cases, these things aren't being built. Now, why is this important? Again, why do we care? Well, because this is a major part of the AI story. And therefore, it is potentially a major part of the AI bubble. We're seeing huge amounts of investment into these data centers and also a huge amount of debt that is being issued to build them. In fact, when you look at the investment grade debt market, AI is the single largest source of debt in the US right now. There is more debt being issued in AI right now than in the entire financial sector. So in other words, what we're dealing with here isn't just equity risk. It's not just that we might see a wipeout in the values of many of these AI stocks or these AI private companies. We're also now dealing with credit risk. We are looking at the possibility of defaults on these data centers, and it could happen at a very large scale. Now, this isn't to say that the data center boom isn't going to happen. It almost certainly will. But it is to say that this boom, which everyone's very excited about, it's not going to be anywhere near as big as many investors seem to think. When you look at the actual economics of these things, suddenly you start to realize, actually, this stuff doesn't really make sense. And if we had to make a prediction, we would estimate that roughly a third of these data centers that have been announced, roughly a third of them will never actually materialize because the economics just don't work here. So next time you see a big data center headline like this one, these huge multiples, all of these very exciting investors, just remember, take it with a grain of salt. The investors are big, the numbers are sexy, but don't let that distract you from what is actually realistic. You always have to ask yourself lines. That was largely driven by data center revenue, which rose 75% year over year in the quarter. Revenue projections for the current quarter also came in higher than investors had expected. Nvidia stock rose as much as 5% after hours, but then moderated during the call. Salesforce also reported yesterday, but those earnings had a very different outcome. The company's revenue grew 12% in the fiscal fourth quarter, which was its fastest growth rate in 2 years. However, investors were disappointed with the company's revenue guidance for 2026. That sent the stock down nearly 6% after hours. Joining us to unpack these earnings, we are speaking with Gil Luria, Head of Technology Research at D.A. Davidson. Gil, good to see you. I want to start with NVIDIA here. Another incredible monster quarter. This keeps on happening. Everyone thinks that we're going to see an issue, and everyone gets very anxious, and then just an unbelievable quarter. Your initial reactions?
Well, not only is it is unbelievable, the numbers are just getting staggering, especially for a company that's so profitable to be able to grow at these rates continuously. But beyond that, they just said they're going to grow sequentially for the rest of the year. They don't typically give more than one quarter out. So the fact that they have that visibility and talked about that going into calendar 2027 tells you that they have more visibility than ever. Their customers are making longer-term commitments than ever. They can see the rollout of the data centers happening at such a rate and with such a backlog that they know that they'll be able to continue to grow from here on out, which is, again, very impressive, especially when the numbers are this big.
What does this mean for the I don't know if I could call it AI bubble story at this point. The AI anxiety story, maybe we have to call it. I mean, we saw the Citrini research article that came out this week and got everyone very anxious about AI. We've seen just incredible drawdowns in the software sector, again, because of AI. What does this do to the AI story? How are investors thinking about this now that NVIDIA continues to dominate?
Well, there's two different types of anxiety, and they're actually the polar opposite of each other. One level of anxiety is, oh my goodness, we're building so many data centers. This can't be sustainable. When it stops, the music's going to stop. The economy's going to decline. NVIDIA's going to decline. The mega caps, the hyperscalers can't afford to do this. That's one level of anxiety that we've been living with for a few months. The other level of anxiety is the exact opposite. Oh my goodness, AI is so potent, it's going to run us over. It's going to go industry by industry and destroy it. And software stocks are worth nothing at their terminal value. Those two things are opposite. Either you believe AI is great and it's going to transform the economy in 2 years, or you believe that AI isn't that good and we're going to stop building data centers. Those two things are opposite types of anxiety. And we think that, I've lived with a lot of anxiety in my life, but we can take a deep breath and say, both of those things are pretty extreme perspectives. What we do know is that AI is incredibly valuable. It's very potent technology that we are just starting to realize how useful it is to both business customers as well as consumers. Business customers are willing to make long-term commitments, which is why Microsoft, Amazon, and Google are building these data centers, because they have these long-term commitments. And consumers are willing to pay more and more for these subscriptions and using these tools in an even more comprehensive way. We know that's happening. So the anxiety about AI isn't real and we don't need these data centers. NVIDIA can help us put that aside by telling us, look, this data center construction is going to continue. On the anxiety of AI is happening too fast and everybody's going to be unemployed, we can also take a deep breath about that and say, somewhere between software engineers that are very much impacted by AI and nurses that are probably not going to be impacted by AI in decades, we have all the other professions. And yes, AI is going to impact every single profession in that progression, but not all at once. Some professions are more susceptible than others. They will change. The hiring around those will change. People that no longer fit in that profession will move to the other professions. This is not going to happen in a 2-year time frame. Those types of essays are science fiction. They are doomer porn. We can put them aside and just focus on what's in front of us, which is a very powerful technology that could drive productivity growth, which is a good thing. It'll help increase the value of our labor, which will get us paid more. It'll help our companies grow faster so they can hire more. That's the more likely scenario than those extreme concerning scenarios.
I think that the Salesforce earnings is a good sort of foil to the NVIDIA earnings, both coming out the same day, which is a reflection of those AI anxieties that you just brought up there, that AI is going to be so great that it's going to kill all of the legacy companies. I look at these Salesforce earnings, revenue grew 12%. That's very strong. I looked at remaining performance obligations, $35 billion, which was actually higher than expected. The only issue was the revenue guidance for the year, which everyone is saying was a miss, but to me it was a meet. I mean, they said 45.8 to 46.2 billion. Wall Street expected 46 billion. That to me, that sounds like exactly what they said. But shares are tanking, down nearly 6% after hours. What does that earnings tell you about the AI anxiety story? And what do you think of these earnings? Do you think that they are as bad as everyone else seems to think they are?
I think the least of Salesforce's issue is AI. I actually think the issue at Salesforce is that their business is just decelerating rapidly. The growth rate was higher this quarter because they acquired Informatica, which is contributing at least 3 or 4% to that growth rate. So they're already only growing high single digits. Just a couple of years ago, they were growing 15%. It's their business that's decelerating for reasons that have nothing to do with AI. They're losing share to HubSpot and Monday and ServiceNow and Braze and Klaviyo and a whole cottage industry of companies that are providing sales and marketing software that's just better than Salesforce. Having said that, what you're saying is spot on in that the market is going to glop onto this and say, oh my goodness, AI is killing software. It's not. Salesforce is just decelerating and the results are declining. There's been plenty of companies that have reported good results so far this quarter, but their stocks went down anyway because of this negative narrative about software. But in Salesforce's case, it's really about just their core business not doing well.
What do you think about the tension of this AI anxiety right now? You mentioned there's the AI is going to be less impactful than we thought it was going to be, which is why it's a bubble. And so the valuations of everything are going to come down. And then there's the other argument, which is that AI is going to be so powerful that it's going to ruin all of the business models as we know it. Those two forces seem to be in real contention with one another. And I'm struggling to figure out which one is actually the dominant sentiment on Wall Street, which one is actually the right sentiment, which one is crazier than the other. And it's hard to sort of parse out what the price of these stocks are actually telling us at this point, because those are two, as you say, completely opposite stories.
I'd say that we've been living with that first type of anxiety, the data center build out isn't going to get a return for several months. The software anxiety is more recent, but I'd say both are playing out in the market right now and causing a lot of fear. But I would actually posit that maybe that's about something bigger. The fact that investors are so jittery right now is probably an indication that we've had a very long bull run, that there's concerns about the U.S. government and its policies, the geopolitics of our global relationships, our geopolitics of our trade policy that has to change every week now. And so I think the market is jittery. It's looking for bad news. And now we have two opposing but compelling and scary stories that investors are telling themselves that are causing them to knock down stocks. I think that there is that layer of just overall jittery markets based on where we are from an overall macroeconomic and a geopolitical perspective.
My instinct when I see these massive sell-offs is, I think, similar to yours, which is this seems to me an overreaction. This seems to me highly emotional and not nearly grounded in the reality that we're seeing on the ground and the data, not nearly enough. At the same time, I could also see someone saying, you're just sweeping these concerns under the rug. It's convenient for you, especially you, Gil Luria, as someone who's in this industry, to say it's not a big deal. People are overreacting. Things are going to be okay. Look how productive the technology is. What would you say to those people?
Then I'm really not trying to sweep anything under the rug. I'm talking about we all have to make weighted probability decisions about potential outcomes. I'm just saying we're overbuilding data centers is a 10% outcome. The AI is going to run everything over in the next 2 years is a 10% outcome. And there's an 80% outcome that neither of those terrible things is going to happen. And if that's the case, we need to look at what the investable opportunities are. So one of them is NVIDIA, trading at 25 times when AMD and Broadcom are trading at 32 times with not as good of a business. Software, which for years traded on revenue multiples, which was always ridiculous. What does it even mean to be 6 times revenue or 8 times revenue? That means nothing. Shareholders only get cash flows. The value of a company is only the value of their future cash flows. All of a sudden, we're looking at this big universe of software companies on a cash flow basis, on an earnings basis. We have Microsoft at 20 times cash flow. We have ServiceNow and Dynatrace and Adobe trading at less than 20 times earnings or cash flow. And we have super hyper growth companies like Snowflake and Datadog and Shopify trading at maybe 35 times cash flow. So those are actual real opportunities that the market has created because of the extreme scenarios. But I don't want to sweep them under the rug. They are potential scenarios. I'm just taking the weighted probability and saying, I think there's 80% right up the middle that we're going to be fine, that AI enhances productivity in a way that makes software companies better, especially winners in software. Not every software company. There'll be plenty of software companies that fail, but the good ones will win, and those are more attractive.
Is, quote, plummeting. It's not true, and incomes are rising fast. Trump also touched on new initiatives, including the Trump investment accounts and a pledge to make big tech cover its own electricity needs. While domestic issues dominated the speech, Trump did briefly touch on foreign policy as well. He claimed that he's ended 8 wars and warned that Iran is rebuilding its nuclear weapons program. He also briefly acknowledged the, quote, unfortunate ruling from the Supreme Court that deemed the tariffs illegal. Earlier that day, his new 10% global tariff rate officially went into effect. So, here to discuss the State of the Union, we're speaking with Ian Bremmer, founder and president of Eurasia Group. Ian, thank you for joining us on Prof G Markets.
My pleasure.
So, this State of the Union, Trump spoke for a record 107 minutes. Lots to unpack here. Let's just start with your initial reactions. What stood out to you?
I had 108 minutes, but I mean, we might have started and stopped the timers at different points. You never know. It was very long. And there wasn't much new there. I mean, there was a surprise that a high-level member of the Venezuelan opposition and someone that would be credible in a democratically elected government released, and then surprised right there, introduced to his family right there in the Capitol building. That was a pretty big deal, frankly. I mean, it wasn't just cinematic. It is an actual success of the Trump administration, and it's a success for an attack against an authoritarian regime. This is like forces of liberty and freedom. This is the kind of thing that any American president, if they had done, you would say, good on them. So, and yeah, I got to be excited about having the American hockey team win the gold. I remember being in Vancouver for the gold medal match back when the Americans and the Canadians liked each other. And it was one of the most exciting sporting events I've ever been to in my life. I don't even like hockey, but everyone was so excited to be there. And frankly, the Americans were pretty happy for the Canadians were there because they're more excited. They're more excited about hockey at the end of the day. But it was great to see them come home after that extraordinary overtime win that could have easily gone the other way. And there they were, and excited, and they're athletes first and foremost, and they're flying the flag, and they're proud to be Americans, and everyone was cheering them, and that was great to see. But I mean, I'm obviously starting with the good moments, right? Because after that, there wasn't a lot. There wasn't a lot. The economy is not doing well. Trump cannot will it so. This is Prof G markets. You know that. The average American is not happy about where the economy is. Trump is underwater on that. He didn't mention Epstein, even though it's been what we've been talking about for weeks now. Larry Summers is being forced out of Harvard. He clearly did not want to go. He was kicking and screaming. There are a lot of Democrats that are getting in trouble. So why is it that Trump is actually not saying a word about this? And it's because it's a two-tier judicial system, and he's protecting himself. He's protecting his members of his cabinet, his friends, and that's clearly unpopular for him too. And there are only so many more months to go before midterm elections. And if those elections were today, the Republicans would get thumped pretty badly, and he knows it. He knows it. So this was not an easy speech to give. For someone who's only going to have so many opportunities to be in front of the population and really explain to them why it is they need to turn out for him and for the people that are his proxies on the ballot in November, he didn't do much of that last night, in my view.
It sounds like we might agree, or at least my initial reaction to this State of the Union address. I expected it to be, or at least was waiting and preparing for it to be quite awful, or at least somewhat insane, kind of unhinged. That was kind of what I was expecting. What we saw was a speech that was relatively normal and relatively less unhinged, in my view at least, for Trump. And I think one of the things that you bring up there is there was a lot that he didn't say, and it seemed that he was actually weaving around all of the things that seemed to be going wrong for him. The economy would be an interesting one. There were some moments where he flat out lied about things, like when he said, prices are coming down, which is just not true.
Not true.
The 18 trillion in foreign investment that didn't really seem to make any sense to me. I don't know where he pulled that number from.
I mean, for me, the 65 million people that he personally saved in India and Pakistan, I mean, were that true, he should be president for life. That's pretty extraordinary. Of course, it's utter bollocks. So, yeah, I mean, it is, to be fair, you're saying it's normal for Trump, and that's a significant caveat.
Yes.
I think that we should try to avoid that caveat because it is still a representative democracy. Look, I mean, the biggest thing he had to respond to was his signature policy for his first year was struck down by the Supreme Court. I've never seen that happen in a State of the Union before. And there the Supreme Court justices are, and people that he appointed voted against his signature policy because it was clearly illegal. And he was told by members of his cabinet, this is illegal, sir. You don't need to do this. You can actually do these tariffs in other ways and you're not going to get hit back. And he refuses to listen. That is uniquely batshit crazy. It's an own goal. And now he's got to deal with the consequences of that. Makes him weaker.
And he seemed quite sheepish about that as well. He seemed quite sheepish about the tariffs. He was mentioning things like the border over and over again, didn't really seem to mention the tariffs at all, which is interesting because, as you say, that is the centerpiece of the policy and it's the biggest news of the week. I would also love to get your reactions to the tariff policies that we've seen, the decision from the Supreme Court. Now we've got the 10% tariffs. He says he's going to bump it up to 15%.
Right.
As the foreign policy expert, what does this mean for other nations? What does this mean for foreign governments, if anything?
Well, the reason he did not want to do it this way, aside from the fact that he's undisciplined and impatient, is that it gives him maximal, unchecked, unilateral authority to place tariffs on anyone, not only any country, but frankly, on pretty much any company, any sector, for whatever reason he chooses, which the president just doesn't have the right to do. Because now he still has tariff authority, and that tariff authority will absolutely allow him to put these tariffs on most of these countries at pretty much the same level, but it is going through an investigative process which allows those countries to then respond. And that process is precisely what Trump wanted to avoid. So it constrains him more. It turns out that the American president is not Xi Jinping. He's not Vladimir Putin. And it's not only because he has midterm elections, though that is one pretty significant component, but it's also because there's an independent judiciary. And even if it's 6-3 conservative, and even if he appointed a bunch of them, it turns out that they actually follow the law as opposed to the president. And he doesn't like that, but it is the reality. And that is good for the corporations. It is good for the markets. And you'll note that when the Supreme Court did its ruling, even though it was an extraordinary and historic ruling, the markets didn't really move. And the reasons they didn't move is because this was well expected and anticipated by those of us that have been following this. You don't have to be brilliant. You just have to be reading to understand that it was never going to be allowed. In fact, if the only surprise is whether it was going to be 6-3 or 9-0. 6-3 is not a surprise precisely because we've seen many instances where the law was equally clear against Biden, where it was 6-3 in the other direction. All of these, major questions, issues that Biden was pushing up against illegally, and the Supreme Court whacked him down. But the most liberal appointees chose not to align with the majority. That's an unfortunate reality of some degree of politicization of the Supreme Court justices, but ultimately doesn't undermine the institution, in my view.
Final question here. We have to ask you, because while we have you, we rarely get to speak with you on this program. He said he ended 8 wars. That was the claim. And then he listed a bunch of countries. He said he ended wars in Israel and Iran. And then he said he's ended the war in Gaza, but then said it's slightly progressing. I forget his exact language. What do you make of that claim? Is it right? Is it wrong? If so, how wrong?
It's has elements of correctness. Modi refused to give Trump credit for bringing about the ceasefire. In reality, he and his administration, particularly Marco Rubio, also J.D. Vance at the margins, played a significant role, not unilaterally, but played a significant role in helping to get those two sides to ceasefire. It is unfortunate that Modi gave him no credit. It is ludicrous that the Pakistani prime minister says he should get the Peace Prize, but the reality is somewhere in between. Armenia and Azerbaijan, he has advanced the cause of peace, but the two sides were not actually fighting when he got engaged. It's a lot easier to end a war when they're not fighting. The case of Israel and Gaza, I give Trump a lot more credit in resolving that conflict to a degree than under Biden. We actually have a U.S.-led peace plan that got Security Council resolution approval. The Russians and Chinese abstained. Everyone else voted in favor. All of the Gulf states and the countries in the region favored it. Trump facilitated the release of all of the hostages, both living and remains, and has been able to move ahead a ceasefire that has not held perfectly, but has held more or less, with humanitarian restrictions of aid now being largely ended. And so we no longer have mass starvation in Gaza. So, I mean, frankly, he was lying a lot more dramatically on the economy than he was on foreign policy, in my view. And in some of the places where he hasn't done that well, like Russia, Ukraine, he didn't really mention. I think he got 20 seconds, Russia, Ukraine, because he said he was going to end the war, and he's failed at ending the war. And he's admitted repeatedly that he's failed at ending the war. So, he's not complete.
View of the State of the Union address from me. There's been a lot of talk about the address, as you would expect, but I would like to just take a moment to focus on what was actually said in the address, and more importantly, what wasn't said. So let's just start with what was said. Interestingly, the issues that Trump talked about the most were actually the ones that he's kind of getting right. For example, the child investment accounts, unfortunately named the Trump accounts, which gives every American child a free stake in the stock market. We have discussed why we think this is a great thing in previous episodes, and it surprisingly made a very large appearance in the speech. I did not expect that. He also talked about the cost of healthcare and the cost of pharmaceutical drugs and the cost of energy, which will only go higher as we ramp up these data centers. And he actually offered solutions to those problems, and he did speak to them at length. That is surprisingly pretty good, especially for a guy who usually spends all of his time at the podium rambling from one usually racist talking point to the next. Now, that isn't to say that it was all good. He certainly did mix in his fair share of racism, calling Somalians, quote, pirates. He also had his fair share of lies. He claimed he's brought down prices. He hasn't. And he also said that he secured $18 trillion of investment, which was probably his dumbest and most egregious lie. But that is kind of par for the course with Trump at this point. What was most interesting to me about the speech was actually what he didn't say. And that is, he barely talked about tariffs. He also didn't talk at all about ICE. He also didn't talk about our relationship with Canada. He didn't talk about our relationship with China. He didn't talk about all of these great trade frameworks that he's been hashing out. And of course, he didn't talk about Epstein. Now, the Epstein omission, I kind of understand. But the rest of those issues, those have been central to his entire agenda. So there's an important question. Why isn't he talking about them? Well, I think those omissions were really a tell. Specifically, I think he and his team know that he is actually losing on those issues, and perhaps even further, that he is wrong on those issues, that he's wrong about the tariff policy, wrong about his handling of ICE, wrong about allowing his agents to gun down 2 American citizens in the middle of the street, wrong about all of this. And so instead of trying to fight these issues on the biggest stage of all, they took what is arguably the smarter route. And that is, they chose to ignore them entirely. And so it appears that Trump's team is actually clocking what is happening here. The fact that 60% of Americans think he is doing a bad job on the economy. The fact that 2/3 of us think his tariffs were a bad idea. The fact that his approval rating has fallen 12% in just 1 year. Trump is in trouble. And it appears, based on the revenue guidance for the current quarter, the cloud company revealed it will collect over $455 billion in future contract revenue from the latest quarter. Part of that revenue comes from a massive deal with OpenAI, which will purchase $300 billion in computing power over 5 years. And in this fiscal year, cloud revenue is projected to increase 77% to $18 billion. Shares surged 36% on this news. It also made Larry Ellison the world's richest person, worth nearly $400 billion. Okay. If you've been listening to the show for a while, you know we have been bullish on Oracle for a long time now. I first laid out our bull argument for Oracle back in March of 2024. But one thing that makes me actually pretty bullish on Oracle here is if you look at the cloud infrastructure market, there are four players basically. It's AWS, it's Microsoft Azure, it's Google Cloud, and then there's Oracle. And Oracle is the only one out of those four that isn't developing its own LLMs, and therefore that isn't competing with other AI companies. So supposedly within the AI startup community, which is obviously growing, there's actually some real incentive to partner with Oracle, because you want to partner with the guy who's not going to compete with you. They're all trying to eat Amazon, Microsoft, and Google's lunch. They don't have to worry about that with Oracle. And so I think that's sort of the thesis, and it's beginning to be reflected in the numbers. That was March 2024. 6 months later, we said it again in September. Oracle is kind of the fourth musketeer when it comes to cloud computing. The options are basically Amazon, Google, Microsoft, or Oracle. We discussed it again during the summer of this year, and now here we are. And indeed, we have an AI company that is paying hundreds of billions of dollars to Oracle to be the compute provider. Since that first podcast we put out in March of 2024, Oracle has tripled in price. And now, as of today, Oracle is up 98% year to date. So, very exciting day to be an Oracle investor. Also a huge day, as I mentioned, for Larry Ellison, whose net worth increased more than $100 billion within 40 minutes after the markets opened yesterday. Okay, for more on Oracle's earnings, let's bring in Gil Luria, head of technology research at D.A. Davidson, to break it down for us. Gil, good to have you on the program.
Thanks for having me.
So, monster quarter for Oracle. Let's just start with your headline reactions. What stood out to you?
They added more than $300 billion to their backlog, which is something I don't know I've ever seen. I don't know that that's ever happened. So that's the very, very positive reaction we see today has to do with that, with the fact that they said that by 2030, they're going to get $144 billion of revenue. That's 10 times what they're doing in that cloud business right now. So that was the great news, completely unprecedented, and what got everybody excited today.
So that was what got me excited too. I've been bullish on Oracle for a while. The way we've been describing it and discussing on the program is it's kind of like the fourth horseman in AI. You've got Microsoft and Amazon and Google and Oracle basically nipping their heels. And then, we see this $455 billion in remaining performance obligations, that booked revenue. But then we also get this report from the Wall Street Journal, which I'd like to get your reaction to, which is reported that Oracle and OpenAI have signed this compute purchasing agreement, and it's worth $300 billion. In other words, it sounds like all of that new revenue coming in from the cloud business, sounds like it's all OpenAI. Is that right?
Aha. So yeah, sometimes when you see something for the first time and it looks fantastical, it's because it is fantastical. I live in the Pacific Northwest. If I walked into the forest and thought I saw Sasquatch, my initial reaction would be to get super excited. But then my next reaction would be, wait a second, is that just a mangy bear? And I would say that what we found out from the Wall Street Journal today means that maybe this is a little bit of just a mangy bear. OpenAI is a not-for-profit that hasn't raised enough capital yet to write this big of a check. It's a not-for-profit that's in the process of fundraising and has negative gross margins. We're all very excited about their product, but that's a very far reach from them being able to commit to $300 billion through 2030, in addition to their commitments to Microsoft, to CoreWeave, to Stargate, to SoftBank, to Crusoe, to Lambda, to Google. So that may be a little bit of a reality check on what the Oracle announcement from last night actually happens to be.
Yeah, it's really interesting. It sounds like you don't believe that $300 billion is realistic in terms of converting that from these remaining performance obligations into real revenue. But I guess what might be helpful is some color on what is a remaining performance obligation. I mean, if they're coming out and saying in their earnings, yes, we have $455 billion in revenue in the pipeline, where it's up 359%. It's ready, it's there. Does that not mean that it's signed and sealed, that OpenAI, whether or not they can afford it, they're going to have to figure out some way to show up with the money and pay it to Oracle?
It means that there's a contract. In this case, a contract between Oracle and OpenAI. No purchase orders, no revenue, no delivery of services. None of that's happened, but there's a contract. And the contract could be very good, but it's one thing to have a contract with Microsoft or Google or Amazon, which is what we thought we heard last night, to having who are the most credit-worthy companies in the world, versus having a contract with a company that, again, is negative gross margin, is going to lose a lot more than it's going to have in revenue this year, and is still organized as a not-for-profit, is still renegotiating terms with its key investor, Microsoft, which has been dragging out for months. Until they're done renegotiating those terms with Microsoft, they are limited in their ability to raise capital, which they're going to, again, need hundreds of billions of dollars of capital to pay all the obligations that they've made. So it's not quite the same as saying that you have a contract with Microsoft when you're saying you have a contract with OpenAI.
So just looking at the stock's reaction, because this was what jumped out to me too. And I've been trying to think, okay, how are they going to pay them the money? Maybe they'll just take on a load of debt to do it. Perhaps they'll just borrow and then they give the money over to Oracle. But looking at the market's reaction, we saw a tiny bit of a pullback, but not really. I mean, Oracle's still up 36% on the day. It was up 40% and then pulled back a little bit. It sounds like the market believes maybe this isn't as incredible and fantastical as they originally thought, but it's still pretty great. Any thoughts on the market's reaction?
I think the market reacted very strongly to believing in the AI trade more than ever. That's what you saw today. That's why NVIDIA was up a lot. Even companies like CoreWeave, which is a direct competitor to Oracle and didn't win the business, they were up 20% today. So it was absolute euphoria around AI. So I think by the time the journal article came out, I don't think there was a lot of critical thinking. As folks and investors start to digest the news and realize what's real and what's not real, I imagine the reaction will be a little more subdued. Having said that, we're not saying OpenAI can't live up to those obligations. The success of ChatGPT is also unprecedented, right? 700 million weekly active users 2 years after it was zero is quite impressive. And they're very likely to continue because, as we know, we're now ChatGPTing things, we're not Googling things. So it's very possible that OpenAI will able to restructure, raise capital, grow the business, live up to these obligations. It's just not a foregone conclusion, which also means that the capital is not going to be as easy to get. We're to fund all this build out, we're mostly going to be relying on debt capital, on lenders being willing to lend to OpenAI and many others now. And the competition for those loans is going to get a lot more serious. If the market for borrowing to build data centers was mostly CoreWeave, in the last year, CoreWeave's raised $10 billion of debt to build data centers. That was most of that lending market. In order to satisfy OpenAI's need and Crusoe's needs and Stargate's needs. And by the way, Meta wants to borrow to build data centers, and xAI, Elon's company, wants to borrow to satisfy all of that capital. We're going to need a lot more debt issued into this market, which again is not a foregone conclusion. It's possible, it's not a foregone conclusion.
Yeah, it's just so interesting. It all kind of, I'm so glad you brought up the creditworthiness of OpenAI. The idea that this gigantic, the fact that we now have the richest man in the world who is Larry Ellison. And when you really think about it, it all kind of hinges on the creditworthiness of OpenAI. Can they raise enough money in debt? Because that's the only way that they're going to be able to fund this thing. Having said that, Oracle is expecting cloud revenue to hit $144 billion in 2030, as you said. Do you think that's realistic? Do you think that that is something we can really expect? Do you believe that number? What do you think?
No, I don't think it's realistic, which doesn't
Okay.
mean they can't grow the cloud business in a very significant way, especially this year, next year. It's one of those, if you shoot for the stars, sometimes you land on the moon type of situations. But for Oracle to have a business go 10 times bigger, while Microsoft is growing its Azure business 39% and Google Cloud 28%, and AWS growing a much bigger business 17%, and all these other upstart neoclouds like CoreWeave and Nebius, to believe that all those data centers are going to get built over the next 5 years to generate all that revenue is very far-fetched. Which isn't to say we're not going to grow AI, we're not going to grow compute, we're not going to grow data centers. All those things are happening, will happen. The tools that AI is providing, those models are getting so powerful, so useful. We're bringing them into the workplace, right? It's not even IT departments that are giving us these tools. That's all going to happen. But to get from here to 10 times as much revenue and have that happen across the whole industry, there aren't enough chips, there isn't enough energy, there isn't enough capital to get to those types of numbers. But again, maybe they shoot for the stars and land on the moon.
Mhm. All right. Thank you very much. We appreciate your time. Gil Luria, Head of Technology Research at D.A. Davidson.
Thank you, Ed.
Okay, so let's review $7 billion in cloud revenue last quarter. A big number, but still behind Google, which did 14 billion, still behind AWS, which did 31 billion. The big three in cloud infrastructure are still Google, Microsoft, and Amazon. Amazon is the number one with around 30% market share. However, we are now looking at nearly 80% cloud growth for Oracle in fiscal 2026. That is a big deal. We are also looking at a projected average growth rate of 70% over the next 5 years, which would mean that by the year 2030, according to those projections, Oracle's cloud business will be as big as Google's cloud business. Now, do we know that that will happen? Can we really believe in that 100%? No. As Gil said, this is a prediction, this is a projection, and so much of it hinges on that $300 billion contract with OpenAI. And we don't know for sure that OpenAI is going to make good on that contract. So we will see. But the net of these earnings, the reason we are seeing this huge run up is the following. The fourth horseman of AI has arrived, and it is Oracle. Hot on the tail of the three largest this product launch, we have Apple's most loyal customer ever. This individual has purchased more AirPods than the rest of America put together. He also says that if you don't own an iPhone, you can't get laid. And that actually is not a joke. That is actually what he believes. Here he is, the one and only Scott Galloway. Scott, how you doing?
I'm good. I didn't say can't. I just said less likely. I mean,
So yeah, let's talk about the product launch. We've got the iPhone 17, the iPhone 17 Pro. We've got the thin iPhone Air. Were you excited by any of it? What did you think of all of these new products from Apple?
I thought it was a hand job and an Advil. I think it was fine, but it just wasn't what we were hoping for. It's just sort of like, okay, a super thin iPhone. Was anyone saying my iPhone is too thick? I don't. The iPhone, I think it seems very incremental. It seems very boring. I believe that the only thing that seemed kind of interesting was this multi-lane automatic or AI driven, Siri driven, and AI and Siri are becoming oxymorons. But essentially, real time language translation. Now, there's equivalent products already out there. You'll see on the execution. But what I have said about AirPods is that it's the most underrated tech product of the last 10 years. And that is essentially what AirPods are, which I'm wearing right now, is they're not a tech product. They're the most ubiquitous, profitable piece of jewelry ever sold. These are $300 earrings that 75% of America has purchased at whatever it is, 50 or 70 points of gross margin. So AirPods are the most successful piece of jewelry in history. Their ability to transfer health information to your phone and Apple Health is basically saying, kind of just borrowing utility from the Apple Watch. I think it makes the Apple Watch less utile. The upgrades or improvements to the Apple Watch seemed just incredibly mediocre. I thought I would describe this entire product release as meh.
What are your thoughts?
I'm in complete agreement with you, meh on everything. We've seen basically the same device for, I would say, almost 10 years now. I mean, the iPhone really hasn't changed. If you look at all of the new specs on the new iPhone, they're basically like, this one is better, and it's newer, and it's better, and it's better. That's all they're really saying. I mean, you can zoom in further on the camera than you could on the previous iPhones. Also, it comes in orange. So on those points, that is where I stand. And by the way, we've been saying that on the product launches for the past, I don't know, 1 or 2 years.
Yeah.
This is part of my confusion as to why this company is still valued as a growth company. They haven't been doing anything that has actually really been growing their product lines. They haven't come out with any devices that are really any good. The only new thing they've come out with is the Vision Pro. And as far as we can tell, the Vision Pro has been dead on arrival. And we're still waiting for them to actually report the numbers on that device. But anecdotally, from what we have heard from external reporting, it's not doing very well. Now, the one thing that they did do that I think was interesting and new in this product launch, as you say, is that AI translation on the AirPods. The fact that you can have your AirPods in, walk over to someone who's speaking another language, and it will translate in your ears in real time. And then you can actually respond to them, say what you want to say, and then hold your iPhone out in front of the person, and it sort of translates it for them in real time. That to me is kind of a game changer. That's pretty legitimate. I'm wondering if you feel the same way.
Yeah, but Ed, when Daddy is rolling up to the bar after a couple of Zacapa and Cokes, his shoulders are multilingual communication vehicles. I got the same thing accomplished with this rhythm. Look, you know what I'm saying here, ladies. You know what I'm saying. Anyway, look, these. How do we recover from that? Let's go meta.
World-renowned professor of marketing, Scott Galloway, with short business insights.
Everyone understands that lingua franca, my brother. Look, what's the larger point here? AirPods that give you real-time language, that's just not what the most valuable and arguably innovative company in the world, or if it's number 2 right now behind NVIDIA, should be doing. And this represents, and there'll be some heckling from the cheap seats, a transition that's taken place since Jobs left the company. And that was, Jobs was considered a builder. He refused to do stock buybacks. He called them financial engineering. He wanted to amass an enormous cash hoard, which gave him the flexibility to take big swings and make big bets on really interesting products. He was a builder. Cook came in, and about the same time, there was pressure from activist hedge funds who wanted share buybacks. Initially, Carl Icahn. Cook, probably to his credit, said it's not worth fighting, and he initiated a series of share buybacks that have amounted to, I think, 700 or 800 billion. In some, Apple could have purchased Eli Lilly or Novo Nordisk with the money they have spent buying back shares.
Yeah.
So you've gone from builder to operator. He will get a lot of second guessing that this is a mature company trading at a growth multiple, and in order to maintain that growth multiple, which is about 33 or 34, he should be not doing financial engineering and buying back shares, which admittedly for a mature company are a good way to return money to shareholders, but taking some of that money and quite frankly, maybe having an AI strategy or trying to come up with a new vehicle for distribution. But what this will 72 hours post this kind of product thud will be a lot of second guessing around, all right, has this company become mature before it needed to, and should be they taking some of that cash, or they've purchased 40% of their outstanding shares back in the last 10 years, which means in 25 years, which isn't as long but not long, they would effectively be taking themselves private. So this is a thud. The market doesn't like it. And it'll bring up a bigger question around the balance between financial engineering, returning capital to shareholders, and taking bigger swings when your company is valued as a growth company.
Yeah, exactly. Product innovation. And to your point on AI, what is so interesting is we heard almost nothing about AI in this product launch. I mean, you'd expect that the world's most innovative company would be innovating in the most ascending technology in the world right now, which is AI. We basically heard nothing. I mean, what we heard was we have this real-time translation, and that's kind of part of the AI story. But other than that, not really anything on Apple Intelligence. And so it appears that the company is still behind the ball when it comes to AI. But Scott, we won't take any more of your time.
Just one more point, Ed,
Yep.
that if you think about, I just totally lost my train of thought. Oh, where am I? Mom? Read my soup, Manny. Where am I? Oh, God.
Too
What was
many
I talking
beers.
about? What was I talking about? Wait, hold on. I'm gonna think of it. It was vital to our national defense. Oh, AI. There we go. Look, so this is what I think happened. Tim Cook knows he needed to talk about AI. Apple has to have an AI strategy, and this is their strategy and why they didn't bring it up. Their strategy is the same as their search strategy, and that is they want to focus on their hardware products and then lend out their interface and custody of the billion most aspirational consumers in the world and license it and make just as they made the Apple iOS kind of or Chrome the preferred browser of Apple phones, and they took a $25 billion royalty payment from Alphabet, of which 24.9 billion drops to the bottom line. I believe Tim Cook's strategy around AI was, we don't want to get into this capital arms race. We're just going to let everyone else raise a shit ton of money, and then we're going to go to Anthropic, and we're going to go to OpenAI and say highest bidder gets to be the default AI amongst the billion wealthiest consumers in the world, or basically anyone that matters. And my guess is he cannot bring that up in the middle of a DOJ, in the midst of an environment where Google was just found guilty of monopoly power, and the remedy was they can't do direct dealings around a royalty payment for exclusive access to Chrome. This would just raise so many legal antennae if he said, no, we're announcing a deal with Anthropic and they're giving us $10 billion to be the exclusive AI LLM for iOS. So my guess is this case that came down against Google had kind of, if you will, cleared the announcement a little bit around AI.
All right.
Where am I? That's what happens when you get to my age, Ed. You literally don't know. I don't even buy green bananas anymore, Ed. All right.
You're working too hard.
Yeah, I'm working too hard.
Okay. Is far from over. I mean, it's going to go to the courts now. It might even go to the Supreme Court. It's a very big deal. And it will be up to the courts, it will be up to the justice system to decide whether an allegation of fraud meets the definition of cause. Indeed, the judge has said no. But let's get some more analysis on this ruling. Our producer Claire Miller spoke with Sarah Binder, Senior Fellow in Governance Studies at Brookings and also Professor of Political Science at George Washington University.
The key question here in this ruling that comes from the judge is, what does for cause mean in this context? And how was it determined? And what rights does Lisa Cook, as the governor accused of malfeasance, what rights does she have, essentially, in face of these charges, which have obviously not been convicted or indicted? So what does this mean? Well, the judge sort of parsed through the history of both the Federal Reserve Act and both other cases around the time when that provision was put into law in the 1930s. And she probed the government, the DOJ lawyers, when they were in court in a hearing. What do they mean? What does Cook's lawyer think it means? And she comes down and essentially says really two things: that for cause can't be whatever the president says it is. It can't just be, something. It has to be something more than policy differences, but it can't be as low as what the government has basically hinted at. And she says, her reading of the statute and the history, it can't be for behavior before you were confirmed to office.
Right.
So she argues, really, first, government hasn't met the threshold here of what counts as cause. And she said there's a procedural part, too, which is Cook is asking for basically notice of the charges in detail and also a hearing to defend herself. And so the judge says, Fifth Amendment, due process clause of protection, that hasn't been established here. And for those reasons, she comes down to say there is for-cause protection, and it's not demonstrated that there is cause yet.
And just for context for the listeners, the allegation that Trump is levying at her is that she committed the fraud in 2021, but she didn't assume her role at the Fed until 2022, correct? So, in other words, she didn't do this while she was in office.
Correct.
So it doesn't fall under for-cause.
Right. That is the judge's interpretation here.
Right. Okay. So all of the reporting on this decision describes it as a roadblock for Trump, but not the end of the discussion. So my question is, what more is there to talk about? Did the judge not just decide that this firing was illegal? Why is this case still ongoing?
So, Annie, our court system at the federal level, it's a hierarchy. So it gives the losers here, the defendant, the government here, the opportunity to appeal. And in this case, it goes to the appellate court that sits above the D.C. Circuit. And then, of course, were the president and the government to lose again, there could be a second appellate review. But ultimately, the Trump, were he to lose the appellate court again, would appeal to the Supreme Court. And at the end of the day, what the Supreme Court says is going to be the final say here. So I would think of this as a road bump. I don't know really, is it a blockade here for the administration?
Okay. Is your prediction that this makes it to the Supreme Court?
This will undoubtedly make its way there, assuming that the administration loses again at the appellate court. But even my guess is Cook would eventually appeal to the Supreme Court to get a final say.
Okay. I want to get your take on this line from the decision from Judge Cobb. She wrote, quote, "Further, the public interest in Federal Reserve independence weighs in favor of Cook's reinstatement." So really, this decision is not just as simple as this firing wasn't for cause, case closed. Actually, Judge Cobb is kind of weighing in on this larger issue of Fed independence. So I'd like to get your take on that line.
So she's doing that for a reason, which is, think of it this way. We've had many other cases during 2025 where Trump has summarily dismissed agency members and commissioners, even though their statute also said you have for-cause protection. But the Supreme Court has let those firings go ahead while the courts, these cases play out in the lower courts. But the Supreme Court did say in one roughly similar case, they said, don't think this applies to the Federal Reserve because the Federal Reserve is this unique institutional body. So what the judge is doing here is using she quotes directly from the Supreme Court, what some people call a bespoke arrangement to protect the Fed. And she's saying, look, the Fed is special. We do expect it to be insulated from political pressures and insulated from just summarily dismissing a governor because you don't like their votes on monetary policy. And so that's what she's doing here. She's not making a rule for all independent agencies. She's making one specific and saying, regardless of what happens to other agency positions, for sure, this is one where the statute envisioned protection, right? Congress wanted to protect these governors from the president just picking them off because he didn't like them raising rates, for instance.
That was Professor Sarah Binder from George Washington University. As you just heard, this will now likely go to the Supreme Court. The next question is, of course, how will the Supreme Court respond? They do often rule in line with this administration. However, the case here, it simply looks too weak. I mean, until Lisa Cook is proven to have engaged in fraud, until a court rules, yes, she did commit a crime, she was unable to serve properly as governor, until all of that happens, after the company slashed its outlook for the second time this year. Full-year revenue growth is now expected to be in the range of 8 to 14%. That's down significantly from its previous top-range target of 21%. Meanwhile, profit growth was also revised to 10 to 16%, and that is down from a top-range target of 24%. So disappointing numbers from Novo Nordisk, and the market is understandably punishing them for it. The stock is now down nearly 40% year to date. Clearly, something is not going right for Novo Nordisk. And the question is, what? What is driving this slowdown? What is driving these guidance cuts? What is the problem for this iconic GLP-1 company at a time when GLP-1s should be having their big moment? Well, according to management, the problem is copycats. As we've discussed before, many other healthcare companies have started to make their own makeshift versions of GLP-1s known as compound GLP-1s. Hims, for example, is a name we've discussed a lot. Last year, they started offering compound GLP-1s, and the reason they were able to do that, despite not having FDA approval, is because there was a GLP-1 supply shortage. And the rule in America is, if drugs are short on supply, other companies can make compounded versions of them without having to go through the formal FDA approval process. So Hims got into GLP-1s, so did many other companies, and understandably, that started to eat into market share. So that's what Novo Nordisk said was the problem, which seems reasonable until you remember two key details that seem probably more important. The first is that this GLP-1 supply shortage is now over, which means Hims and Hims equivalents can't make GLP-1s anymore. So that's not really a problem anymore. And the second is a way bigger deal. And that is that Eli Lilly, Novo Nordisk's biggest competitor, just overtook them in the United States. Eli Lilly's product, Zepbound, is now more popular than Wegovy, and it controls 60% of the US market. So it is strange that, despite this crucial detail, Novo Nordisk declined to mention their competitor one time on the investor call. Meanwhile, they mentioned compounds, a way smaller issue, 69 times. So to better understand what's going on here and how the market reacted, our producer Claire spoke with Emily Field, head of European Pharmaceuticals Equity Research at Barclays.
The company seems very focused on this copycat problem. They seem much less focused on the fact that their biggest competitor, Eli Lilly, has taken the lead in the weight loss drug prescriptions market. So do you think that part of this massive sell-off is potentially the market telling Novo Nordisk they're focused on the wrong threat?
Yeah, I think that, kind of with the benefit of hindsight, when this market was really exploding and throughout the summer of 2023 was when things really started to kick off. We talk to doctors all the time, and the vast majority prefer Lilly's drug, putting everything else aside because you lose a little bit more weight. And the feedback is that patients have a better time on the drug. They have less of the gastrointestinal side effects like nausea and whatnot. That's not in the clinical data, but that's what we hear time and time again on the side effects from doctors, right? But when the market's growing up and to the right, everything's in shortage. It's kind of just like, this is a duopoly and it's going to be the biggest market ever. So like, who cares? We kind of we're not really paying attention to a lot of the competitive dynamics between the two of them because it felt like it wasn't really relevant. Well, fast forward 2 years later, the companies have ramped up supply, so supply is not an issue anymore. Yeah, they're losing share to Lilly, and even we talked to a doctor here in the UK just a couple of weeks ago. He's completely stopped using Wegovy and gives all of his patients. It's still branded as Mounjaro outside the US, but he has every single patient for weight loss on the Lilly drug and not the Novo drug. And so, what I was hearing from investors as the call was ongoing this afternoon was just people kind of thinking that Novo, and to answer your question, is the market telling that they're focused on the wrong thing? I think that could be a fair statement because I think that the share price reaction today is telling you that they're not taking perhaps drastic enough action to address this volume problem that they have. Because, let's say compounding did go away. The doctors who are making the choices for the patients still prefer the Lilly drug. How do they fix that? How do they address that?
Right. Have they put forward any plan for that?
Yeah, and that's kind of been I've been covering this company for about 5 years now, and they tend to be very, very high level when they talk about their plans. The one thing that Novo can do, which they haven't done, and they haven't given any evidence that they're going to do, is start a price war. Because, if they have the inferior drug, how can they make themselves look better to payers, PBMs? Cutting the price is the one thing that Novo can do. And obviously that would just be bad for Lilly because they have to follow suit. We generally do not see price wars in pharma. And, I can't really think of an example where we've seen that on the branded side. It happens in generics, but that's a totally different landscape. So I think that that's what people are really worried about for Lilly, that just, that Novo, I guess, will, not play in the sandbox.
So the takeaway is pretty clear here. Eli Lilly is crushing it. Zepbound is on a tear. And instead of acknowledging it and addressing it, Novo Nordisk has decided to kind of pretend it doesn't exist. Or at the very least, they are trying to distract us away from that problem and get us to focus on a company like Hims. But the market's not buying it. Hims is a $14 billion company. Eli Lilly is a $750 billion company. This is not the kind of bait that Wall Street's going to fall for. So that's probably why you saw this reaction yesterday. That's why the stock dropped nearly 30%, not only because guidance was bad, but also because management was just not being that realistic about the problem they're facing, specifically Eli Lilly. So Novo Nordisk continues to get hammered. It's down 60% from a year ago, now trading at below 20 times earnings. That is well below its recent high of 40 and also below its 5-year average of 33. So perhaps there might be a buying opportunity here. Perhaps this was a little overdone. After all, GLP-1s are just getting started. A third of Americans are interested, but only 4% are using. So tons of opportunity there. And perhaps they could initiate this price war, as Emily Field suggests. Nevertheless, there is a larger learning here, both for investor relations and probably for life. And that is that you're